So, you're doing business in Indonesia. Then you absolutely have to get your head around PPH Pasal 23. Now, I know, it sounds a little intimidating, but understanding it is just essential. In this explainer, we're going to give you a really clear, comprehensive guide to what it is, how it all works, and, most importantly, why it matters to your bottom line. Let's get into it.
At its heart, this is what's called a withholding tax, and it touches just about everyone in the business world. Seriously, whether you're a freelance consultant getting paid, a small business paying for services, or even a huge corporation paying out dividends, PPA Pasal 23 is right there, playing a huge role in how that money actually changes hands.
So, here's our game plan for making this all make sense. We're going to start with understanding what this tax really is. Then we'll look at who's responsible for it, who cuts the tax, and who gets their payment cut. We'll dive into what types of income are covered, what the tax rate is, and, just as important, what's exempt. And finally, we'll wrap up with the process and, yes, the penalties.
All right, first things first. Let's start at the very beginning. What exactly is PPH Pasal 23, and why does it even exist?
Okay, the official definition can sound like a bit of a mouthful, right? Let's just simplify it. The best way to think about this is like a tax down payment. When a business pays for a service, it holds back a small piece of that payment and sends it straight to the tax office on your behalf. This is why it's called a non-final tax. It's not some extra charge, it's actually a credit you can use against your big annual tax bill. It's really just the government's way of making sure taxes get collected nice and smoothly all year long.
So, in every single PPH 23 transaction, you've got two main characters, and understanding their roles is absolutely critical. So let's meet them.
On one side, you have the withholder. This is the person or company that's making the payment. They're the ones legally responsible for doing all the work, doing the math, cutting the tax from the payment, and sending it to the government. Then, on the other side, you have the withheld party. That's the one who provided the service and is receiving the payment, just, minus the tax that was just taken out. So the key thing to remember is that all the admin work falls on the person who pays.
So you might be asking, who exactly has to be a withholder? Well, the list is actually pretty long. It includes government agencies, of course, but also all domestic corporations, event organizers, and even specific professionals like accountants or lawyers when they are paying rent for their office. It's a really wide net, and it's designed to make sure the rule applies to pretty much any formal business deal.
All right, now for the main event. What specific types of income actually trigger this withholding tax? Let's get into it.
So this tax applies to a very specific list of income sources. We're talking about payments from capital, like dividends and interest. We're also talking about payments for intellectual property, which are royalties. And then you've got things like prizes, rent for assets like a car or equipment, and a huge, huge category of professional services.
Let's zoom in on dividends for a second. This is simply the profit a company decides to share with its owners. But here's a key detail about timing that often trips people up. The tax isn't due when the money is actually paid. It's due when the dividend is officially declared. For a private company, that's usually at the big annual meeting. For public ones, it's on a specific official date.
And what about royalties? When most of us hear that word, we think of authors or musicians. But in the world of tax, this category is way, way broader. It covers payments for using patents, designs, trademarks, even for the right to use special industrial or scientific equipment. It's really all about paying for the use of someone else's idea or asset.
Okay, so we know who pays and on what kind of income. The next big question is pretty obvious, right? How much?
The main rate you need to remember for all that income from capital and similar things is a pretty straightforward 15%. And it's really important to know this is calculated from the gross amount of the payment. That's before any other costs or deductions are taken out.
Just to be super clear, this 15% rate applies specifically to those capital-related income types we've been talking about, so dividends, interest, royalties, prizes, and awards. Now, there is a separate 2% rate that applies to services and rent, but for this explainer, we're really focusing on this primary 15% bracket.
Now, it wouldn't be a tax law if there weren't a bunch of exceptions, would it? And honestly, knowing what is not taxed is just as important for making sure you're doing everything right.
So does this mean every single dividend or every single interest payment gets hit with this withholding tax? Well, the short answer is no, thankfully. The regulations have some very specific and very important exemptions.
For example, any interest you pay to a bank is exempt, mainly because that's handled under a whole different set of tax rules. Also, dividends that one local corporation receives from another are often exempt. Why?
Well, it's to avoid taxing the same profit over and over again. And payments that a cooperative makes to its own members, also off the list. See, these exemptions are there for a reason, usually to encourage investment and just make the whole system a little more efficient.
We've covered all the theory, so let's wrap this up with the practical side of things. What do you actually need to do, and what happens if you don't?
For the person or company withholding the tax, the process is actually a really simple 3-step cycle every month. First, you calculate the correct tax on any payments you've made. Second, you pay that amount you withheld over to the state treasury. And third, you report the whole thing to the tax office. That's it. Calculate, pay, report.
As you can probably guess, there are consequences for not following through. The rules include administrative sanctions if you're late with your payments or reports, so staying on top of these deadlines is really, really important.
And this brings us right back to maybe the most important takeaway of all, especially if you're the one getting paid. Remember how we said this tax is non-final? This is what that really means. It is not an extra tax. It's a prepayment. It's an installment on your annual income tax bill. Every single rupiah that was withheld can be claimed as a credit, and that directly lowers what you owe at the end of the year.
And that's our comprehensive tour of PPI Pasal 23. It's a fundamental, unavoidable part of doing business in Indonesia. So the question I'll leave you with is this. Now that you're armed with this knowledge, how are you going to approach your next payment or your next invoice?